Portfolio Builder members, welcome to our Wednesday Trade Alert. Daily income trade alerts at noon Eastern. Target return of investment is 1% a month, and we've only had one losing month of negative 1% with an average return of 1.5%. Current trade allocation per $75,000 is slightly overweight in equities. However, we still have strong positions in the bond and gold market. Currently, expectations are to generate profits from the equities and slowly bleed a little in our bond and gold portfolio. But the big picture is that the Fed is massively injecting capital into the Treasury market, supporting those yields. And this is also very bullish for gold. Only thing it needs is a scare. This puts your portfolio with 100 shares trading the SPY ETF. That's a US 504 company index product that trades Monday, Wednesday, Friday with the options market. This allows us to sell covered calls 3 times a week for income and buy very cheap duration put options to protect from downside risk. And this is currently our largest position with $30,000 in this position. Meanwhile, we have 200 shares of emerging markets. Emerging markets is a new play we added on Tuesday that is up currently, and this is predicting that we get a phase 1 US-China trade deal accomplished. And this should push the emerging markets ETF up probably around 20% in the next several months, as long as the trade talks don't break down. Now, there are some problems already emerging with the trade talks, and that's why we want to have that big position in the TLT and GDX. The next bad piece of news that comes out will push TLT significantly higher, and I think our ramp up on the TLT is not over, even if a phase 1 deal is closed. Phase 2 deal has very little likelihood of being accomplished. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Income and safety, not growth or speculation. If you follow our program, you'll be able to simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. For every $300,000 invested, our goal is to generate a $3,000 per month profit with very little drawdown. Now, if you look in the description box, I'll show you where that is. You can apply for our advisory right here or call Dean. And we have financing plans that can get you started for as little as $997 down today. That will gain access to both our bootcamp and advisory. Here's what you'll get. Easy to follow daily income trade alerts Monday through Friday at noon Eastern. A approximate 1-hour video, which is this video, explaining the thinking behind the trades and how to get in and out of them. You'll get an optional spreadsheet just like ours to track your results. And our promise to you is to protect your portfolio and help you pick up the low-hanging fruit with a target return of 1% per month. In our 16-week retirement income bootcamp, you'll be turned into an options trading machine that can print safe profits out of the stock and bond market. This is primarily a webinar that's delivered every Monday and Tuesday. Monday is Q&A and catch-up, and Tuesday is lecture and modules with homework assignments. And of course, we also provide commentary and extra trade alerts to our bootcamp members. Now, we're not trying to create some sort of advanced options trading education that will confuse you. It's very simple and focused specifically on our style of trading. So call Dean right now, 505-322-7515, and we can get you started. Okay, let's take a look at the most recent trade alert, and then we'll take a look at the top news. So on Monday, we sold a relatively conservative covered call. It was only 70 cents above the trading price and collected 92 cents. So it had limited upside. and we purchased the 292 put. So we gave up profits if the SPY went above 297, but still made money. And on the other hand, could lose no more than the price of 292 on our SPY because we're long that put. So let's take a look at the risk graph. You can see this setup generated a profit if the market went slightly down, stayed flat, or went up, but had very limited upside, $1.27 a share maximum profit if the market went higher, which it did. On the other hand, we had a little more exposure to downside risk, and this was expecting a slow but steady grind back to that $300 level on the SPY, maybe slightly higher as we get news flow about the Phase 1 China trade deal, which is already having some hiccups. If we do look at the results, the SPY went from 296.33 to 298.73 for a $2.40 gain. Our option caller brought in a credit, started out of 60 cents, but we had to pay $1.79 to get out, so we lost $1.19 on the option caller. The net profit was $1.21 on 3,700 shares, or $4,447 in the last 48 hours. A summary of the key news: China's upset over the Hong Kong bill. The U.S. is trying to pass to make sure that China is allowing Hong Kong to remain autonomous, and China is very upset about this. China also came out saying they want all tariffs removed before they'll commit to $50 billion a year of agricultural products. But meanwhile, the inflation in China is rising, primarily due to food prices. So I think they are motivated to buy food almost no matter what. Their inflation rate's closer to 1 if you strip out the food. So they do have room to increase their credit impulse, which will be important for our emerging markets play. It's really just the food that's giving them issues. Also, the producer price index, the PPI, is dropping. And this is because manufacturers are having to lower prices to offset tariff costs and keep their exports strong, which are also dropping, as well as real estate and car sales. So you're probably wondering why we're buying emerging markets when their data is so slumped. Well, that's why it's at a 20% discount, and all the big billionaires are loading up on this. As far as the Fed, we're expecting lower rates in October, but there is some dissent among members. We're seeing the dot plot not showing cuts, although it hasn't been showing cuts all year. And Repo Madness was oversubscribed overnight, 75 billion offered, 80 billion requested. Repo rate jumped again. A unit of $1 billion hedge fund filed bankruptcy. And again, we're still waiting to see just how much assets the Fed's going to buy in a one-time shot, expected to be around $300 to $500 billion before the year's end, to give these banks some more cash. If we look at our return, we started the month off very strong with a 1.1% return, and that quickly swung the opposite direction on us for a 0.5% loss. Not worried about it, folks. Our TLT and GDX was delivering the big profits this month as the China trade war was escalating. And if you think the trade war is going to be rosy from here on out, good luck to you. Go all in on equities. I prefer to have the TLT there to save the day, as it has in 9 out of the 11 last months. We've delivered most of our profits from owning the TLT. So there was a sharp sell-off Friday from the surprise news on this Phase 1 trade deal, but we're already seeing China back out of it. So I think there's plenty of room for the TLT to travel higher. As we know, the general move for rates is towards zero globally. PMIs globally are low, so this is when the banks will lower rates as low as they can possibly go and inject money into the banking system. So let's take a look at today's trade. First, you had to close out the call option. So you'll see that your call option lost money. That's always good, folks. That means we made money on the underlying asset. It's nothing to be worried about. So we bought to close the 297 call for $1.79, but we still came out with a profit. And I think we're going to have a hard time jumping over this 300 to 303 range on the SPY. So expect, as we get closer and closer to that level, without a major breakthrough in the trade deal, I will go for these big juicy credits and risk us missing out on some of the upside profits. And again, the put option was only worth a penny, so you cannot sell it. So just let that expire worthless. Here's our new trade setup. You can see I'm selling at the 301 level, and this is where there is a lot of selling via call option selling in the 300 to 301 range. We're already seeing China saying that they want the tariffs completely removed before they sign a deal, and they're already threatening retaliation regarding this Hong Kong deal. So trade uncertainty remains, and it makes sense to play it safe right now. We are a little bit overweight on equities now, as I do suspect China will succumb to a deal, but if they don't, that TLT is going to deliver yet another big profit for us. Here's our risk graph. So you can see we sold the 301, bought the 296 collar, and this is a maximum risk of 287 per 100 SPY and a maximum profit of $213. So we're slightly at a greater risk than profit potential. But remember, if we do get a big sell-off, the TLT can go up significantly higher and offset the cost. So we're in a good spot right here for a consistent, safe return. Look at the top stocks and news of the day, of the last 24 hours. Pretty much everything's in the green. For our 4 core holdings, we have the SPY. Again, it has had trouble getting above this 300 to 302 level. I think with the phase 1 deal, we can jump to a 315 to 330 range, which we call the danger zone. TLT had a little bit of a sell-off because of that Friday news, but you can see it's still an upward trend. We know the general movement of the central banks is towards the zero interest rate policy, and the Fed is going into a phase of QE. So we want to remain long the TLT in case anything goes wrong with this phase 1 deal. Emerging markets, again, to get back to its 2017 highs, which you can't actually see in this chart, would be at $52 a share. So it can go up about 20% to get back to its old levels, which I think is very possible with a phase 1 deal. Gold miners, as long as we have gold prices in the $1,500 range, we dipped a little bit lower than that on this news, is a screaming buy because they can finally make money. They've been beaten down, and to get back towards the 2012 highs would be in the $60 range. So we remain long GDX with no protection on this part of our portfolio. The exchange rate of the dollar against the yuan is sitting at 7.12 is the highest in this period. Just several months ago in August, it dropped down to 7.08 after the Friday trade deal, potential deal at least. And part of the deal was to fix their exchange rate. So we're carefully following that. Again, if the trade deal breaks down and they raise tariffs, which I think could happen, maybe not this year, but potentially into next year, as the phase 2 deal does break down. I see, John, your question. Yeah, John, so the secret to doing well with our program is to keep the right ratios. So let's review the ratios one more time. So this is the recommended ratio currently, John, and it's 48% equities, 40% bonds, 12% gold approximately. So just multiply that and keep us even set so that you have the correct allocation to get our same results. So currently we're heavier on the equities position, but we remain long the bonds and gold because of the overall setup in the markets. If we look at the bond market, I like to follow the German bond. That 30-year is above zero. It had not done that for much of the year, and I think it has much lower to go, again, if the China-U.S. trade deal breaks down. China really needs outside capital to continue growing its debt bubble. Otherwise, it's going to be in a heap of pain. So right now, because it looks like we may be allowing China to get a lot of outside capital from our banks, that they have enough room to increase their credit line again and get another boost, like they have several times in the last decade with all these various construction projects they announced, from Belt and Road to just mindlessly building skyscrapers all over their country. This morning we had a drop in the retail sales, mostly from car sales dropping. Car sales in China have been dropping rapidly. The repo madness still continues, which signals the Fed must inject money. The rumor from the banks is that it will be to the tune of $300 to $500 billion one-time injection to take off all these securities off the bank's balance sheets, free up capital, and then most likely they'll roll into stocks if we get this trade deal. And a lot of that money will flow to that EEM ETF as well as the SPY. Trump says China started agricultural purchases, but deal won't be signed until November. We've heard this a million times. Is China really in enough pain to do a deal? We'll see. PBOC surprises the market with 200 billion won cash injection via one-year MLF. So this is a lot like their repo market, and is a way they inject money into their system. China car sales still very strong, but you can see it starting to slump and slow down, which mimics their general economy starting to slow down. Hong Kong's economy slipped into a recession in Q3 following a decline of 0.5% in Q2. So the protests and drama in Hong Kong continue to weigh heavy on both Hong Kong and China. Shanghai housing sales plunge. These big skyscrapers they've built are not filled. China has a huge problem, especially if these trade talks break down. Now remember, just because we have emerging markets on the Tuesday play doesn't mean we have to bet up. We can easily sell the in-the-money covered call and buy the in-the-money put to profit from a downside move in emerging markets. So if we start to see that trade deal break down, we can easily flip to that immediately and then look at going to long silver once we see the shit really hit the fan. Deputy level Chinese trade meetings will happen this week. We expect one more call between the heads of the U.S. and Chinese trade teams and possible meetings in mid-November. The administration is pushing to have a phase one deal on paper by mid-November. They've been telling us this for 2 years now. China to retaliate over U.S. House's bill on Hong Kong. On one side, you have a repressive regime crushing democratic freedoms in Hong Kong. On the other, you have young people speaking out for freedom and democratic reforms, proud to stand with Republic McGovern in support of today's bipartisan votes showing the House's committee to Hong Kong. So now China has the Democrats and the Republicans on their ass, and it'll be interesting if they want to continue tempting more tariffs from tariff, or if they're going to go for a period of ease with the phase one deal. China urges U.S. to stop pushing forward bill over Hong Kong. Our record economy would crash just like in 1929. That's the Great Depression after World War I, and after a lot of malinvestment in the roaring 20s. If any of those clowns became president, Elizabeth Warren really stood out in the debates last night. Here's her 2-cent wealth taxes, the way she's branding this wealth tax on the billionaires. She wants to take 2% of your wealth per year. So I guess over the period of something like 20 years, you lose half your wealth. Here's some of her highlights. Universal child care. If we do listen to a lot of the Fed interactions with different business leaders, a big concern is this child care. They don't want to go to work because child care would cost more than what they can make. She's pushing for a universal free public college, $50 billion investment in HBCUs, canceling student loan debt for 95% of the people who have it, and more. Another quote from her that stood out: "We need to address the elephant in the room, how campaigns are financed. Today, I announced that I'm not taking any money from Big Pharma, Big Tech, or Wall Street executives." Well, surprise, they're not going to give her any money with her policy. You can't go behind closed doors, take their money, and then expect them to enforce the rules. After the financial crisis, I had an idea for a consumer agency that would stop banks from cheating people. Republicans, big banks, even Democrats told me, "You'll never get it passed," but I fought hard. To date, the CFPB has returned $12 billion to American consumers. With a 2-cent tax on the richest top 0.1% of households, we'd have enough money to pay for universal child care, provide universal free public college, all of her stuff. So she certainly has surprised me. I initially thought Kamala Harris was who they were trying to push alongside Joe Biden, but Kamala has really fallen off, and Biden continues to struggle. And here is an interesting graph about federal debt held by the public, and we can see a lot of these market crashes were after the public accumulated a huge amount of debt relative to the GDP. So we're nowhere near the World War II levels or the world, I guess that's the only time it's been this high. So we're definitely getting towards very high. Hey, Scott, sounds good. I'll see you at the next webinar as well in about 40 minutes. So with the current projection of our expansion of debt, we will be at the World War II levels sometime in 2035. Put Elizabeth Warren in there. We'll be there much sooner. Some stuff from Bloomberg. Beijing is laying down more rules of play in its trade war with the U.S.-China officials. They don't want to agree to the $50 billion until they roll back the tariffs. China imported approximately $20 billion in 2017, so this would be quite a big increase. John, I'm looking at your ratios, so the SPY to TLT should be 2-to-1. And then for every 100 shares of SPY, you have 200 of emerging markets. So yeah, you don't quite have the same ratios. So at $300,000, John, you would just take this and multiply it by 4. So you'd have 400 shares of the SPY, 800 shares of emerging markets, 800 shares of the TLT, and then 1,000 shares of GDX. Here's Bloomberg part about the Hong Kong Human Rights and Democracy Act. Mark Rubio has all kinds of bills he's trying to pass that are anti-China. So Ray Dalio's been very good about reporting on that, as he has a huge chunk of his portfolio in emerging markets, as well as a lot of money from China that he manages. Breaking news, Brexit deals within sight. That was, I think, last night. And then this morning they said it's still not ready and it may not happen. But if that were to get passed, it could be a potential rotation for Tuesday or for a buy and hold position in VGK. So that's your best index product for Europe. They've had a lot of problems because of this Brexit. Not that we're making any plans to do that, but definitely something we're paying close attention to. Biden on Burisma, my son did nothing wrong. I did nothing wrong. I carried out the policy of the U.S. government in rooting out corruption in Ukraine. That's what we should be focusing on. Oh, wow. There's another analyst I like to listen to just pointing out that the Fed's dot plot does not forecast rates, although it hasn't forecasted rates this entire year. And a lot of the speakers have been coming out saying, hey, we don't think you should lower rates. These are mostly the people representing the smaller banks that want the higher rates, who have normal banking operations. "85% of the reporting that's come out from the S&P 500 has exceeded analyst estimates so far. Banks have been coming out very hot this week, so good for our stock strategy. Here's the hedge fund, where a unit of the hedge fund apparently blew out some leveraged investment. I don't know exactly what they did yet, but this just hit the newswire this morning, perhaps related to the repo madness. Canada's CPI is bumping around and above that 2% target level. So we don't have inflation problems in the US, but if we did, we would want to run for the exits in the bonds and in the stocks eventually, because it would cause the central banks to increase rates. Project Veritas got some undercover person in at CNN, and they're talking about Joe Biden having a problem. I haven't watched this episode, but comical. And that is a wrap. So I'll pull up this one more time just so we can make sure. So the ratio has always been 2-to-1 on the TLT to the SPY, and that's because the SPY costs twice as much as the TLT, and we designed the trades so that in general, if we're wrong, we can actually do very well. So with this current setup, we may be risking around $1 to $2 a share on, say, 1,000 SPY, but we have 2,000 TLT, and so if we're wrong, the put option kicks in, the call option we sold helps offset the loss on the SPY, and then the TLT jumps, and we can actually make a profit when there's sudden changes in the market. So does this allocation setup make sense, John? You could just write that down. 1 SPY, 2 EEM, 2 TLT, and then 2.5 GDX. All right, guys, we have our paid webinar in 30 minutes, so I'll see you guys at that in a few minutes. And tomorrow is our free webinar, so make sure to check your email for that. There you go. Dean calculated it correctly. So yeah, it changed Monday, but not a lot, John. It really didn't change that much. So the ratio of the SPY to the TLT has slightly changed. Okay, guys, sounds good, and we'll see you guys live in 30 minutes as well. Thanks again.